As you look at those tighter liquidity conditions, how does that inform the way you're looking to allocate? I know investment-grade credit is still part of the mix for you and the team at BlackRock. Is that view challenged by these worsening liquidity conditions? And if not, which parts of investment-grade are looking most attractive at this point?
Short end of the investment-grade market, in the same way that we prefer short-dated government bonds at this juncture. So, of course, the broader liquidity withdrawing environment is a bit of a headwind when we think about broader risk as allocation views. But the reality is also that we have had years of excess. Somewhat of a moderation from here on is to be expected. So not only kind of the magnitude of the withdrawal, but also the speed and the orderly nature or the disorderly nature of withdrawal matters. Currently, we see QT, for example, working its way primarily through term premium, which is why we are short, long-dated government bonds. But if liquidity withdrawal were to happen, to use Francine's framing, at the perfect storm when something else breaks, then we could have disorderly market unwind, and in which case even more prudent risk positioning is warranted. But at this juncture, we want to stay invested, because also bear market rally can be one of those really powerful rallies. So we want to stay invested in market, but to your point, credit over equities at this juncture is how we want to position.
Well, I feel like I'm the bad cop. I mean, I'm worried when you look at how much it costs of insuring, Credit Suisse. We know that they have concerns, but against default, I mean, this is something huge. What's the probability of having a Lehman moment in some parts of the market? It could be a margin call. We saw it with the BOE. Again, risks that maybe it doesn't have that much to do with central banks, but individual risks that then become something huge and snowball.
No, that kind of moment is by definition unforeseeable, because we're talking about black swan type of moments. But I would say, though, where we are at this juncture is different from the Lehman moment, is different from the global financial crisis, in that we don't have balance sheet recession. We have a recession likely engineered by central bank tightening in order to fight inflation that is very much supply driven. We don't have balance sheet recession that is kind of permeating across all parts of the corporate space. So our expectation for default is more contained versus what's actually in the price, which is why there is still a little bit of value that we want to harvest. But clearly, eyes on where liquidity constraint is leading to higher cost of insuring against default.